The Mag 7, Ryan, have been the talk of the town for quite some time now. Is it pretty much the case that they're going to have to do all of the heavy lifting if the S&P 500 is going to have another big rally?
Yeah, good morning, Dom. It's pretty early, but that's a tough question this early in the morning. But I mean, listen, yes, they have to do a lot of the lifting. We know that. You look at the earnings growth, you look at some of the revenue. It's coming from a lot of those big companies, no question. But does it mean they have to? I mean, there's other parts of this market that are doing well. I mean, literally last week, Dom, if you look like the S&P 1500 advanced decline line, it's 1500 biggest stocks. It made like an all-time high. So there really are a lot of stocks participating, but these large names do matter. Obviously, they make up so much of the overall market that if they were to crack, and we saw last week, they cracked a little bit. The market was down, but most stocks were up last week. So, of course, they matter. We're more neutral. Technology right here has had such an incredible run. Doesn't mean we don't like it. We'll be very clear. But, what they do matters. And, they're still a big part of what's going on. But there are some really positive things under the surface that you wouldn't even notice it because those big names do pull so much.
What's the most positive thing that you're seeing right now under the surface that we are not paying attention to because we are focused so much, Ryan, on the Magnificent Seven?
Yeah, great question there. I mean, honestly, the economy's strong. I mean, we hear so much about manufacturing, and manufacturing's 14% of the economy, so it's not a lot. The survey's been under 50 for the longest time, but you look at like manufacturing structures. I mean, they've been exploding higher, like over 60% the last year, Dom. We've seen the onshoring, right? Bring the chips back, all incredible productivity that's going to come from some of these things. That's stuff that we're not really hearing about. And yes, earnings, of course, are out there. We still think, kind of the earlier discussion before I jumped on here, there still are a lot of positives. Maybe earnings come in a little bit better than expected. And all in all, you've got earnings at all-time high. You've got CapEx expenditures in the next 12 months at an all-time high. You've got profit margins starting to roll and curl higher. Dom, those three things to us are, honestly, pretty big positives for the economy, but also probably the market here that, there's lots of things to talk about, but I don't know if that gets all the love that it should.
Ryan, last week we saw an inflation scare that took down the market quite a bit because of what we saw with the CPI and everything else. Inflation is still a problem right now, and interest rates are reflecting that. The 10-year yields are significantly higher than they were just about 3 or 4 weeks ago. Talk to us then about how that sentiment shift could affect the broader markets. Interest rates still do matter.
Oh, they absolutely matter. And yes, we had that big sell-off last Tuesday, and then we had a huge rally Wednesday and Thursday as people kind of looked at it. And I know everyone's talked about this ad nauseum, but, shelter is a huge part of why that CPI number was higher. If you strip out shelter, your CPI is actually sub 2. So we know that. But I'll just say this much. Seasonality has really played out the last couple of years. What does that mean right here and now? Well, Dom, the next month or so, historically, late February into early March could be a little troublesome. There's a lot of optimism out there after the rally that we've had. So we've been bullish. We've been overweight equities, honestly, since December of 2022. Wasn't always a popular call, but we've been there. And now, we'd be open to the idea, I guess, that you could have some normal seasonal weakness here with some of the potential under the surface. I mean, people have talked about this last point here. The number of stocks above their 50-day and 200-day moving average has been creeping lower, even though the indices moved higher. That's not the end of the world, but it says, hey, maybe we could have that. That's, again, look what happened last February and March, right? We're not predicting another regional bank crisis, but it's funny how these things tend to play out, especially in an election year. First quarter election year is not usually that strong. So we think there could be, a little bit of a banana peel coming up here, but it's just going to be an opportunity because, like I said, we don't see a recession, so we'd still be a buyer.
Ryan, but you mentioned some of the sectors that you think are worth looking at right now. I wonder what parts of the market, certain stocks, certain industries represent the biggest opportunity in your mind in the next 6 to 12 months.
Sure. Well, we like the cyclical names, specifically industrials and financials. I mean, it's not like the headlines have been great for financials, yet all of a sudden that group that was a leader last year continues to do well. So if you don't have a recession, we like those areas. And also, I mean, I know this is a word that gets everybody fired up. We like small caps. We like mid caps also. And I know, small caps have underperformed, but they also up 22% the last 2 months last year. So we think they're kind of just biding their time here. Small caps were up last week, right? When tech and that rotation, we wouldn't be shocked at all, Dom, if we had a rotation out of, tech and communications and honestly into small and mid caps, kind of that underloved area that, again, yes, it's a lot of that has to do with what's going with the Fed and when's the first cut, but still the economy is strong. And last week, even though, yields went higher and interest rate cut expectations dropped, small caps and mid caps led. So that's something I think we should be paying attention to.